Hello, good morning. Thank you very much for joining us today. My name is Ana Elisa Luna, and I'm the Communications Manager for the World Bank in Latin America. And joining me this morning is Bill Maloney, our Chief Economist. So just a few housekeeping issues before we get started. First, there is simultaneous interpretation into Spanish and Portuguese. So you can see the language icon at the bottom of your screen. If you have any issues, please just put a message on the chat. The contents of this press conference, as well as the report and the press release, are embargoed until 11 a.m. Washington, D.C. time. For reference, it's now 9 a.m. We have received many questions, so the way that we're going to do this is Bill will present the main findings of the report, and then we will take questions from you. We will start with the ones that you have submitted, and then I will be checking the chat to see additional questions. If you have not received the press release or the report, please just put your email on the chat and someone from the team will make sure to get this to you. Bill's report today is titled The Promise of Integration, Opportunities in a Changing Global Economy, and it examines the region's growth and the challenges it faces in the near term. Bill, I'm not going to scoop you. I'm going to let you actually take over so you can actually, since you wrote the report. And again, thank you so much to everyone for joining us. We realize also that the time difference for some of you is pretty brutal. So we're particularly grateful if this is what you're doing before you've even had a chance to have coffee this morning. So Bill, over to you. And you need to unmute.
Thank you, Ana. Muy buenos días a todos. Bom dia. As always, our report has two chapters. The first one deals with precisely what we call strengthening resilience and boosting growth. And the second one will deal more with the overall topic of the report, which is why it's important that the region integrate more in the global economy and what the trends have actually been away from that goal. But we'll start with conjunctural state of the region. The first thing to note is that the region has done relatively poorly compared with the rest of the world in terms of recovering from the pre-pandemic, being the region that has grown least since 2019. That varies pretty significantly across subregions. You see that South America has returned to trend more or less and is almost at the trend line it was at before. Central America is not recovering its previous levels of growth, and the Caribbean has not recovered trend yet either, and that's largely due to falls in the lack of recovery of tourism. The forecasts going forward are less optimistic than in previous years. We're expecting 1.4% growth this year, going to 2.4% and 2.4% in 2024, 2025. The reasons for this are in the short run, that we're facing stronger headwinds in the global economy and reduced tailwinds. The first most important thing is that growth in the advanced countries is slowing down, partly as a result of the higher interest rates and fighting inflation, partly as a result of the war in Ukraine. China's growth is now recovering after the lifting of COVID lockdown, but its growth will be uncertain over the near future. Commodity prices are expected to fall, and as we know, numerous countries in the region are very dependent on that. And interest rates, the fourth factor, are expected to remain high until inflation is brought under control. All those things in the short run are implying that growth will be slow in the region for this year. The 2.4% in 2024 and 2025 are not necessarily a result of the pandemic still. Those are largely the same numbers that we had in the decade of the 2010s, which implies that we have structural factors that we need to address. They're also clearly too low to really significantly reduce poverty and reduce social tensions, and hence we have a major agenda ahead of us to raise those rates of growth. Employment has largely recovered, although with some loss in job quality. You can see the black line here is the United States. We're doing better than the United States overall, although in some cases jobs people are taking are of lower costs and some loss of protection, lower wages and some loss of protection. COVID reversed a half decade of progress in poverty. Brazil, with its very generous transfer programs, managed to actually reduce poverty during the pandemic, while the rest of the region, it increased substantially. We're now roughly where we were 5 years ago in terms of poverty, but it's coming back to its previous levels. The fiscal situation in the region continues to be difficult but managed. Most countries have managed to increase their primary surpluses, but the rise in debt service coming from the increased interest has partially offset that. So we're expecting average deficits around 4.4% for last year and falling to 2.7% in the year that's coming. What's important to note is this rise in interest rate costs are not due to necessarily a rise in interest rate spreads. That's to say the country premia that we have to pay as countries in the global markets. It's mostly due to the overall cost in financing around the world. Markets remain relatively calm and guardedly optimistic about the region. Inflation fighting in the region has been good by historical and global standards. In 2022, we faced rates of 7.9%, which is high, but it's below what the OECD experienced and below what Eastern Europe experienced, and perhaps only East Asia has done better than we have at this point. We're expecting that to fall to 5.0% over this year. If you looked over the last 6 months, there's been a steady decline in month-on-month inflation rates since April 22. Expectations of inflation remain largely anchored, suggesting that people believe that the monetary authorities have inflation under control, and we're expected to meet most central bank targets by 2024. So that's a fairly good record. You can argue that between the management of the fiscal situation and good management of the inflation situation, the LAC has reached a kind of macro normalcy in the region, and that's what we're seeing in the moderate spreads in the world markets. This said, we highlight something which is called LAC's integration paradox, which is we've achieved this level of macroeconomic stability, if you will, of normalcy, and that should be attracting more investment and spark growth, but we kind of see the reverse happening overall. Just to look at inward foreign direct investment flows, you see that globally, flows to developing countries have increased steadily since 1990, but they basically stalled in Latin America from about 2011 and decreasing to the present. And that's led to a major fall in the share of flows that the region used to capture by about half to a third. And the second chapter of the report, Reengaging in a Changing World Economy, focuses precisely on the fact that we're not integrating more in the economy, we're actually integrating a little bit less. And this we put in a larger context of LAC's long-run growth problem. If you see the region's income per capita as a share of the advanced country GDP per capita, you see that emerging and developing Asia has rapidly converged. Now they're about 25% of the G7 average income, but Latin America has slipped from about 45% to just above 32%. And that's happening at the same time that we're becoming less active in trade and in foreign investment. This is particularly striking in light of the fact there are two global trends which we find likely to offer huge opportunities if LAC is prepared for them. The first is the trend towards reshoring. The pandemic revealed just how dependent we were on very few, the advanced countries were on very few sources of products, and so there's a desire to diversify sources. And the second, obviously the geopolitical tensions that are arising has made many in the United States and in Europe want to bring elements of the global value chains closer to home. In theory, Latin America is much closer to home, and we should be able to take advantage of those opportunities. The second opportunity is the exploitation of LAC's tremendous green comparative advantage. We have the greenest electricity grid in the world. Roughly 50% of our electricity is generated by renewable resources. And then given that the advanced countries are putting more and more of a premium on goods produced in an environmentally sustainable way, this gives us a great opportunity if we were to ensure the traceability and certification measures that need to happen. We are likely to be a major green exporter, converting our solar and our wind power into, in particular, green hydrogen. We have an abundance of the raw materials that are necessary for green technologies, particularly in copper and lithium. And we have a wealth of natural capital in our forests that offer possibilities for instance, tourism and other sources. Both of these trends offer us big opportunities, but they also imply that we need to be integrated in the global economy, both to take advantages of scale and to get the technologies we need going forward. Yet, if you look at trade, we remain among the lowest traders in the world. We're slightly above South Asia in terms of how much we export and import as a share of our GDP. We undertrade given our proximity to major markets and the number of FTAs we have. That's to say, we would expect to be exporting and importing more. Further, trade has been declining since about 2000, with the exception of Mexico. And we still remain heavily focused on food and commodity exports. If just looking at FDI from a slightly different perspective or breaking it apart by region, this gray line at the top shows how Latin America has been falling since about 2011 in millions of dollars inflows to the region. That is not uniformly affecting the region. You see that Mexico has seen an increase over the last 10 years, about 39% in the stock of FDI, while South America has seen a fall of about 9% in the total stock of foreign direct investment. Most of this, interestingly, is happening from decreased investment from Europe, and in particularly Spain, and the many, many companies that are registered for tax regions in the Netherlands. So this is exactly the opposite of what we might have expected, given these new opportunities and the necessities we have to develop our green comparative advantage. Why is this? Business now says that LAC is wage competitive compared to Asia. So the argument you had to move to the massive market of China, where you had a billion new workers coming on stream, is no longer an argument, because if you look at the figure here, Mexico and Brazil show lower wages overall than China, which is the sixth from the right. But on the other hand, firms report that in terms of taxation and the costs of capital, we remain high, and that pushes up direct costs a lot. But then the other costs, which they cite, which are captured by the orange line on top of the blue line, which captures primary costs, there's a fall in confidence in the stability of political and institutional situation that's been falling since about 2009. While we have made progress on reducing tariffs and to some degree non-tariff barriers, if you look at just trade costs of getting across borders in terms of time and in cost, we're about 4 times the OECD, and that puts an implicit barrier on trade. Infrastructure, we underinvest and we badly invest. We invest roughly 3.5% of GDP, where Asia and the Middle East and even Africa invest more like 7% of GDP. And we don't always put those roads in the right places. And as a result, that impedes movement of goods and services. The services part is especially important right now because that is an increasing part of global trade. And that's what brings digital to the fore. Ideally, in the 21st century, we would have plentiful and cheap digital access, both from a point of view of resilience, but also from the point of view of fomenting service exports around the world. Unfortunately, Latin America is one of the more costly regions in terms of access, and coverage is relatively low. We also, it turns out, have a not particularly welcome environment in terms of our cities, and they tend to be low productivity and relatively congested. And the big bang that you see, for instance, in many Asian cities of having a lot of manufacturing concentrated in a few cities, a few well-designed cities is not generally the case in Latin America, and that's something we need to work on. And finally, our capabilities across the human capital spectrum, both the training of workers, managerial capabilities, and technical capabilities remain weak compared to other regions. And that's something that firms look for when 35% of our firms report a lack of qualified labor as a barrier to expansion. That remains a disincentive. Over the short to medium term, obviously the agenda that I just sketched out, those are long-term issues that we faced in the region for many decades. But over the short term, what can we do to perhaps move towards greater integration with the global economy and take advantage of these new possibilities we have? The first thing we would stress is first, do no harm. The region has made tremendous progress over the last 30 years in achieving this macroeconomic normalcy and this credibility in the world markets. And we want to be able to maintain that. It can be lost relatively quickly. And that means exactly the trends that the region has been following in terms of building up strong reserve positions and ensuring the denomination of its debt is largely in domestic currency. We want to continue moving in that direction. And we also want to maintain the independence and professionalization of our central banks, fiscal and supervisory authorities. All of those have given credibility to in our macroeconomic management. We want to continue that. There's a lot of evidence that well-designed export promotion and investment promotion agencies can both help our exporters enter large markets where they may not be familiar with local systems and local ways of doing business, and also to help foreign investors identify opportunities within our countries. There's a huge increase in export promotion zones and investment attraction zones around the world. We have to consider those carefully because many are poorly designed and not particularly effective. Nonetheless, they are another tool that we could consider over the medium term. I'll leave you there. Thank you very much for your time. And I'm glad to take your questions.
Thank you very much, Bill. And we have a lot of questions. So I am doing my best to try to group them. We will try to get to as many as we can. Please, if you have other questions, please post them on the chat. But Bill, I'm going to start with a few questions that have been sent on the topics of interest rates and inflation. And I have 3 questions for you on this. A couple from Bloomberg about the perspective on inflation levels in Latin America and the risk that high rates could prevent growth in the region. That's one. The second is, do you have estimates as to which country in the region will be able to cut interest rates first, and which will reach its inflation target levels first? So I hope you can answer that one. And then a question from Diario Libre in the Dominican Republic. If central banks continue to raise their interest rates in the United States and Europe, I assume, would it affect less developed countries? How would it affect in less developed countries? So do you want to take those 3 first?
So on the first question, the important thing to realize is it's a trade-off between short-run growth and long-run growth. What central banks around the world do in raising interest rates is they try to blunt rise in inflation before inflation rates can be built into future expectations of inflation and then get built into wage contracts, which then creates a wage spiral, which over the longer term has a depressive impact on growth. So the idea of raising interest rates quickly and in fact of ensuring the independence of central banks is precisely to cut off inflationary expectations as early as possible to preserve long-run growth prospects, even if in the short run it has a dampening effect on growth. We don't have estimates of which countries are going to be able to start lowering interest rates and who's going to meet their targets first. What I would say, Brazil and I think Chile announced that they were going to stop raising interest rates a couple months ago. So we are seeing that with the fall in expectations of inflation. We had inflation of 7.9% this year. We're expecting it to fall to 5% next year. With the success that some countries have had in pulling down inflation. They've stabilized in interest rates, and they'll bring them down as soon as possible. We expect that most of the big countries will meet their targets in 2024. I forget, yeah, we're predicting most of them will meet them. The question for the smaller countries and rising interest rates. Rising interest rates put a lot of stress on financial systems. They obviously make it harder to finance budget deficits, and just in general, it makes investment more expensive. So it has effects on all countries, and the sooner we can bring them down to lower levels, the better it will be for all countries' growth.
Thanks, Bill. So I have a couple of questions for you on the banking crisis. So the first comes from Folia. What impact will the banking crisis in the US have on the region, and how can countries protect themselves? And then a colleague from the banker is also asking for your outlook on the banking sector I expect for the region. And so I'll let you answer this, and then I have a different question for you on poverty, but let's take these two first.
Right. So I think the first thing to note is that part of this normalization that I was talking about, macro normalization, implied having greater supervision of the banking sector. And we saw coming out of COVID, surprisingly healthy banking sectors. Once we removed forbearance measures, we did not see huge increases in non-performing loans. And in recent months, we were seeing increases in profits by banks, suggesting that we were largely out of the woods in terms of the stresses coming from the pandemic. Now, obviously, the banking crises in the United States and in Europe are worrisome. The first thing to note is that the direct connections between those banks and Latin American banks are few. So the possibilities of a direct contagion are minimal. That said, the underlying phenomenon, which is that higher interest rates lower the value of bonds being held by central banks, being held by private banks, can also have an effect in our region as well. And we have to very much continue the vigilance that the supervisory authorities have been undertaking to ensure that to catch troubled banks before anything goes too far.
Thank you, Bill. So the next question is, you mentioned that the region has made some gains in poverty, but do you have estimates for this year in terms of poverty levels? Is this likely to be exacerbated by high inflation and interest rates?
Yeah, so the rise in inflation, and in particular the rise in food prices and energy prices coming from particularly the war in Ukraine, had a significant impact on household poverty and stalled a little bit the return to the lower rates of poverty we had before COVID. We're hoping that this will be moderated over the next year and will continue to reduce poverty, but those numbers we get with some degree of a lag because they're based on household surveys. So don't have a forecast for 2023, but we're optimistic that we'll return to lower levels again.
Thanks, Bill. A few questions on the issue of growth. Why has Latin America lost so much weight in the global economy? This is a question from Bloomberg Linea. And then a question from Deutsche Welle. The outlook is for inflation to fall in the US and the EU EU and the US this year. And with interest rates, how will this also happen in Latin America? And then a more broad question from FA is, what do you see as the most urgent challenges that the region needs to address?
What was it? First question again, sorry.
So the first one is, why has the region lost so much weight in the global economy? Right. The second is, if you see this trend of lowering inflation, or falling inflation interest rates, will that happen in the region? And the last, what is the most urgent challenges you see the region having to tackle?
Right. So I would say it's less, to some degree, it's less that Latin America has lost weight in the global economy and more that the global economy expanded while Latin America did not maintain its participation. So the whole massive subcontracting and outsourcing movement of the last 20 or 30 years has radically expanded international trade and the movement of foreign direct investment, mostly to the Far East. And Latin America was just not as much of a part of that as obviously the Far East was. But it is also the case that viewed as a share of their own GDP, as I noted, exports plus imports has fallen over time steadily over the last 15 years. And that is an interesting question that we need to understand more, particularly since we've been signing more and more FTAs over that time period. The question is, why is it that our exporters are not taking advantage of those opportunities? And I think that that requires us looking at many of the questions that I highlighted, namely the costs of doing business in terms of getting things across borders, the support that firms get in trying to break into foreign markets, the quality of the management of our regional firms, the cost of financing. All of this gets in the way of increasing our trade abroad. In terms of the urgent priorities that we face, I would say that finishing the job on inflation, and this will relate to the second question. Yes, the good news of the last month was that inflation seems to be, the last numbers on inflation came in much better than expected over the last month, and that will hopefully lead to a moderation of the rise in interest rates in the United States and in Europe going forward. And any moderation in interest rates will be helpful for us as a region. That said, I would say the region was a little bit ahead of the United States and of Europe in fighting Europe, and it's why I think Brazil, as I mentioned, Brazil and Chile declared that they weren't going to raise interest rates any further far before the Fed has reached that point. So the hope is that the progress we've been making in the region on inflation will continue, and that interest rates will continue to fall over this next year. The big challenges we face are first to vanquish inflation. This has been a problem in the region. It's been well managed so far. We want to be sure that it's done. And we want to do that in a way that has the least impact on the vulnerable families in the region and that has the least impact on growth. That's a tricky trade-off we have to manage, but that is the immediate challenge. I would say that other urgent things, I think that as we've mentioned in previous reports, we lost about 1.5 years of education due to COVID. I think we are a region which continues to lag in primary education, secondary education. This really hurts our competitiveness compared to other regions. And when people look at where they want to locate a firm, that plays very much into their considerations. And in fact, as we've mentioned, roughly 30% of Latin American firms declare they can't expand because they can't get the qualified labor they need. So that whole education agenda, including dealing with the incredible shock we had during the pandemic, I think is very important to deal with. And then we have that whole series of reforms that I was referring to in infrastructure, overall levels of human capital and the like, barriers to entry and exit of goods. All those things are important.
Thanks, Bill. And just before I jump into the next topic, just a couple of things from the chat. Can you just remind us again of the numbers for LAC for this year and next? And then there's a question from Alma Solis from Panama. Is this the assumption is that these numbers are based on a moderate scenario, but what would change this? What would change this for the better or for the worse?
So again, we're expecting 1.4% growth for the region for 2023, and then rising to 2.4% for 2024 and 2025. Things that would give us a positive bounce would be success in fighting inflation in the advanced countries in particular. That would permit interest rates to not rise any further and to begin to come down. That would stimulate growth in the advanced countries, and that would help. Obviously, the continued uncertainty in Europe is a problem because we don't know where the war in Ukraine is going to go next, but it could again lead to food shortages. We can't know that. The recent announcement by the OPEC Plus to restrict the production of oil is going to keep oil prices and energy prices higher than we were originally forecasting. That's unfortunate. On the other hand, the prices, while high, are not astronomically high, so it's not a huge shock.
Thanks, Bill. So a few questions around one of the issues of the topics of the report, the nearshoring and trade. How can the countries in Latin America, this is from Thomson Reuters and La Prensa, how can the countries in Latin America benefit from nearshoring? Then how do you see international trade flows to the region? And in particular, did you know anything about maritime trade? A colleague from La Prensa asks. And then lastly, how can the region produce higher value-added products and services so as to not depend on weather-affected crops? And this is a question from Deutsche Welle.
Yeah, maybe I'll focus in particular on that last question, because I think that it's a particularly important question for the region, which is how one thing is to increase trade and increase foreign direct investment. Another is how to leverage that for a more holistic, more organic development process for the region. That's to say, in the past, we export copper, we export minerals, we export the like, but we haven't always seen follow-on industries that would link to those industries and create more jobs and more dynamic economies. And I think that's partly been a limit to our growth. So the question of how we get more value added is precisely the question. How do we leverage not only natural resources and the new ones like lithium or green hydrogen, but also, I mean, Mexico is facing the same thing with manufacturers. How do we ensure that when we have these foreign manufacturers come in, that actually we learn how to make manufacturers of higher quality and higher value added? And that is an agenda that requires a laser focus on the human capital needs of the region. And this starts again with primary and secondary education, but then it goes to technical education, what is done in the United States in community colleges as opposed to universities, focus on how our universities are producing students and what kinds of students. We produce a lot fewer engineers than, for instance, Asia does, by about half. And our universities do not work very closely in general with the private sector, which is often what you see in Asia or in the United States or in Europe as part of this process of raising value added and putting more value added in products. And I think that's we need to treat that as a mission agenda itself, treat and say, where do we need to increase our human capital, and how do we go about doing it? It's been a challenge for 50 years. We've known about it. It needs to be moved to center stage. I think that's also answering the question a little bit about how we get more nearshoring. Getting rid of the dumb stuff, like not having good roads or non-functional ports, is it's a straightforward diagnostic, and we know what we have to do. But that's not the only thing that firms look for, and they're looking for qualified labor force. They're looking for people they can work with. They're looking for suppliers. They're looking for stable rules of the game, and that's both in the macroeconomic front, and that's also in the political front. So those are harder to engineer, but we need to work on them too to become attractive.
Thanks, Bill. So I have another regional question, and then we're going to go into the country-specific questions. I know we're set to finish in 7 minutes, but I just want to let everyone know we may run a little bit longer, Bill, if that's okay with you, but we want to try and get to as many of the questions as we can. So before I move into the country-specific questions, there is a question from El Universal in Mexico asking about the evolution of the cost of sending remittances to the United States, in this case for Mexico, but I know this is an issue across the region. Do we have any World Bank projects to make the cost of remittances cheaper?
So that's an important question. Remittances have roughly doubled over the last 10 years, from particularly the United States to the region, and ensuring that they're transmitted in a safe and low-cost way is an important policy agenda item. The bank has many projects working on issues of financial transparency, on fintech, and all of these, in theory, should be working towards making the transmission of remittances safer and lower cost.
Thanks, Bill. So I have a few questions on Argentina. So we're going to start there. From Infobae, if you can talk more about the economic prospects for the country. From Bloomberg, where do you see inflation in Argentina ending this year? From El Cronista, how much impact do Argentina's macro imbalances have on its chances to attract investment? And lastly, from Bloomberg, the market sees the Argentine peso as 330 per peso by the end of this year from the current level of 208 per dollar. Is your base case a major peso devaluation before the end of the year to close the gap between the exchange rates? So very easy questions.
Yes, easy questions. So just to answer the easiest one in the middle, yes, clearly macroeconomic stability is a prerequisite for foreign capital to flow to our region, and but not just for foreign capital. It just makes doing business possible for local entrepreneurs, which I also want to encourage. We don't have a forecast for inflation in Argentina next year. We are supportive of the program of the IMF at this point, and we're hopeful that it will do what it has to do in terms of guaranteeing macro stability. We're also continuing to support the Argentine program. We've got, I think, several large loans this year, replicating what we did last year. But mostly working on the social side and on government efficiency and the like.
Thanks, Bill. A couple of questions on Brazil. So the first one is, Brazil has a very low growth potential historically. How can this be reversed? And the second question is, how do you see Brazil in terms of attracting investment?
Right. So Brazil faces all of the issues that the rest of the region does. As you noted, we're expecting, I think, 0.8% growth in 2023 for Brazil, and then moving up to 2% for the next 2 years. But the question is exactly right. Brazil faces the same issues in terms of education, infrastructure, and the like, and it's going to have to make the same sort of investments in both human and physical capital over time to make more attractive that way.
Then I have a couple of questions, a few questions on Chile. So the first one is, what is the World Bank's vision of Chile? How do you see the rejection of the tax reform, and what do you expect from the dialogue process? That's from Valor. Then a second question is, what are the reasons behind your projections for Chile? And do you have inflation numbers for Chile? And then lastly, are the political uncertainty and external environment a risk to Chile's economy?
Obviously Chile is facing a difficult year coming up. We're expecting a fall of about 0.7% in GDP, and that will bounce back to 2.1% in the year after. That's largely due to a combination of tight monetary policy and the fall in commodity prices. Obviously, Chile is trying to do some quite ambitious constitutional reforms and all. We have faith this is a very competent country with a lot of experience, and they will sort this out over time.
Thanks. And we have a few questions on the Caribbean. The first is, what do you see as the major challenges for the Caribbean, and what are the options for dealing with these challenges? And there's a specific question on Barbados, and I know that traditionally we haven't had very good data for some of the countries in the Caribbean, but I don't know if you have anything, or just to confirm that. And then just to mention, there's a question on Guyana. It relates to a specific World Bank project that I know that's not your area. So I'm just for our colleague from Capital News, Davina, we're asking our communications person who focuses on Guyana to follow up with you for the answer to your question. But more broadly, what are the prospects, challenges for the countries in the Caribbean?
Right. So the Caribbean has been particularly hard hit over the last 5 years, both by the pandemic and then by being importers of energy and food. they've also been hurt by the war in Ukraine. The short-run challenges, I would say, in the first place, we're still pretty low in terms of overall vaccination rates, and that has impeded the recovery of tourism in many countries. Many countries in the Caribbean have actually been quite successful in managing the increase in debt and the shocks coming from food and energy prices quite impressively. But the longer term issues are ones of scale and of thinking through issues of migration and specialization that very small economies need to face. And in the past, integration among the islands has not been sufficient to generate the kinds of markets that we need. So they're going to need to find more and more ways of integrating, both in terms of flows of goods and in flows of people, with larger economies going forward.
Thank you, Bill. A couple of questions from the Dominican Republic. So one that came in before, as to what are the challenges that both of them actually relate to the challenges facing the DR. What are the prospects for the DR, and particularly how does the issue with Haiti, impact its economic prospects?
Right, so the DR we're expecting to grow about 4.4% over this next year, and that's shifting up to 5% in 2025, 4 and 25. So that's doing quite well, and in fact, the DR has grown quite substantially well over the last number of years. The situation in Haiti is obviously dire, and it's involving the bank in coordinating with the UN, with the other multinational organizations. It's not a situation that the Dominican Republic can handle on its own. So we remain just committed to working with the DR to help manage that situation.
Thanks, Bill. I'm going to pivot to Central America. So there are a few questions, and so if you can just talk a little bit about the challenges and the development opportunities for the countries of Central America more broadly, and then if you can specifically just talk about Panama, Honduras, Costa Rica, and Guatemala. What are the growth numbers for those countries?
So let's start backwards. So Panama, we're expecting 5.7% growth this year. Honduras, we're expecting 3.5% growth. And what was the other one? Salvador, 2.3.
Guatemala and Costa Rica.
Guatemala is 3.2, and Costa Rica 2.7 for next year, which are reasonably.
Can you talk a little bit about what you see as the challenges facing the countries? Is there anything particular that you can say about Central America?
Well, so in theory, there's a question of how they can benefit in the way that Mexico has benefited from the reshoring trend. Many of these countries, for instance, were used as offshoring platforms by U.S. firms 20 years ago. And the question is, can we leverage that again in the same way Mexico is doing it? This, of course, requires the same sort of maintenance of public security, of education, of infrastructure that we mentioned in the other countries. But in theory, they're very close to the United States. They have experience with managing export processing zones and the like. So in theory, they have high prospects. Also, we find Costa Rica has done extremely well with tourism over the last couple years. I think the region can benefit a lot from that.
Bill, a few questions on Uruguay. One is your overall view of Uruguay, but a couple of specific ones. One is, what is Uruguay's perspective regarding its bilateral negotiations and its relationship with Mercosur? And second one is, how many years and with what magnitude does the World Bank expect the Mercosur EU foreign trade benefits to be registered if they signed an agreement in 2023? And how do you see the issue of the droughts? We have severe droughts impacting countries in South America like Uruguay and Argentina. How do you see the droughts impacting economic growth?
Right. So we're expecting 1.8% growth in Uruguay this year, rising to 2.8 and then 2.4% over the next couple of years. The issue of droughts is increasingly important throughout Brazil, Argentina, and Uruguay. It highlights exactly the focus that the World Bank is putting more and more on climate change and the need both to mitigate the rise in temperatures, as well as help countries become more resilient to these kinds of climate-related shocks. They've clearly been a drag on growth in all three countries that I just mentioned going forward, and we need to continue working on that. As far as Mercosur and the alliance, the impact of greater trade integration with Europe, it's hard to know when you'd start to see big growth dividends from that. It depends a lot on how aggressively Uruguayan exporters are able to take advantage of access to foreign markets, and then how to leverage those to build subsidiary industries within Uruguay. That doesn't happen overnight, but again, establishing that framework so that foreign capital and domestic entrepreneurs know the rules of the game going forward is a big step forward towards stimulating new activity.
Thanks, Bill. I have a couple of questions for you on Ecuador, but I just want to remind colleagues that that all of the growth numbers are the easiest place to find them is the last page of the executive summary. There's a table there with all the countries. We have the estimates for last year, the projections for this year and next. So I'll come back to a couple of questions on this, but just so you know that that's where you can find this more quickly. So a couple of questions on Ecuador, and we're almost, we'll have this and just a couple more questions. So we should be done, in 10 minutes, but for people who have other things to do, including maybe you, Bill. So a couple of questions in Ecuador. How does the political instability affect economic growth projections for Ecuador? And the bank reduced its growth prospects for Ecuador for 2023. What is driving this?
I can't pinpoint exactly what has been reducing the growth estimates for Ecuador. We're expecting 3% for the year that's coming, and then 2.8 and 2.8% for the next 2 years. Just forecasts for growth for all countries in the world decreased slowly over the last 6 months, and Latin America was no exception. Ecuador is no exception. I can't pinpoint exactly what it is, but Ecuador is a commodity exporter, and commodity prices are falling, and their principal markets are also have slowed growth over this next year. Political instability has a direct impact on growth. It just makes investors more wary, both domestic and foreign, of taking long-run positions. And you can see actually in global perceptions of the region that there's the confidence and political stability of the region has actually declined a bit over the last 10 years. And that's something that does make it harder to both attract foreign direct investment, and it makes it harder for domestic entrepreneurs to plan ahead and to make investments.
I'm just going to come back to a couple of questions on the chat. One is, can you remind us on the numbers for Argentina? And then the forecast, which I believe we had, the last forecast we had for 2023 was 2%, and now it's 0%. So the question is, why did we change this forecast, and what are the drivers of this lower scenario?
Right, I couldn't tell you where it's 0 right now for 2023, and then 2% for 2024 and 2025. Can't tell you exactly what was behind lowering the forecast, but clearly Argentina has a lot of parts moving around at any time.
And then lastly, can you expand a little bit on the reasons behind the number for Panama, the 5.2% growth for Panama? And the question was to you, I don't remember what our projection was the last time, if this is lower and higher, what we expected. So if you can remind us of that as well.
I don't remember whether it's higher or lower, but Panama, we're expecting a 5.7 for this year, and then 5.8 and 5.9 for the next 2 years. So they're doing relatively well by regional standards. And it looks solid going forward, which suggests that fundamentals are in place.
I don't see any new questions, and I just going to give one last chance for anyone if there's something that I missed or something that we haven't answered. We'll do the going once, going twice. I think that I think that might be it. So I want to thank, there's one last, Guyana. Yes, thank you. There were a couple of questions on Guyana, but what do you see as the reasons for Guyana's projected growth? It is experiencing the highest growth in the region. And what advice would you have for the country as it expands its oil and gas sector?
Well, you answered your own question. You don't get 25% rate of growth without having something like discovering oil. So clearly the oil and gas sector is driving those high rates of growth. And the big challenge will be to develop an institutional structure that ensures that those resources go where they have to go, that are used constructively for laying the foundations for new industries to diversify the economy, to deal with, to address long-standing social needs, and just to have a government framework that ensures that these resources are used well. I would say that's the big challenge, and I think that is where the World Bank is actually involved in Guyana right now.
I'm going to close with one last question that I'm not sure you can answer. Venezuela. Anything we can say about, the state of the Venezuelan economy?
No.
No? I don't think we have numbers for Venezuela, correct?
Right.
In the report. Yes, that's what I thought. And then the last question, what do you expect from the meeting that is taking place tomorrow among the presidents of 10 countries in the region to address inflation? Is this a good initiative? And
I think any sharing of information among the policymakers in the region is absolutely positive. And I would say part of the reason for the improved macro performance of the region over the last 30 years has been precisely greater coordination, collaboration, sharing of information, and learning about how to manage better among countries. So I think that's probably good.
So, Bill, I think we're going to close with this. I really want to thank everyone who joined us today, especially for staying with us longer than initially planned. I hope that your questions have been answered. If you need additional information, if you have other questions for Bill or any clarifications, please reach out to us. I think the contact information is in the press release. The materials are embargoed, as a reminder, until 11 a.m., so another hour. Thank you, Bill, so much.
Thank you, Ana.
I look forward to having a conversation with you again in a few months. Thank you,
Thanks
everyone.
to all. Mil gracias. Muito obrigado.
Have a great day. Bye.